how can you hedge? If you want to hedge today, what can you do actually? So first statement is simple and important, that you can hedge in international exchanges or in OTC market. That is LME, CME, SGX, SHFE, etc. These are the exchanges where you can hedge, or in the OTC market. What are the advantages? These exchange prices are transparent. The prices you can see, the counterparty risk is low, but you get standardized products. OTC, the you get bespoke price. Like for example, you want to hedge for 6 months, you will get it. You want to hedge for 16th of February, you'll get that contract that date. You can do structured products, and you may not require a high amount of margin. So the OTC has many advantages, but the problem is the OTC, the price is between you and the counterparty. There's no price transparency. So as long as you understand what the price should be, you can calculate what the prices should be. OTC is not a bad option. And which are the banks which offer commodity hedging in India? Mostly some of the foreign banks. So Indian entity can hedge. Indian entities are allowed to open an account in LME, CME, or with any bank, and then they do the hedging. Now this is an important part. They cannot speculate. So you have to have exposure. It's not possible that you do not have any exposure in aluminium, but you are doing an aluminium hedge. So you have to have exposure, and you have to establish that you have to have an exposure. So you have to have an AD category 1 bank. Who are AD category 1 bank? All banks are AD category 1 bank. So let's say your banker is ICICI Banks, just SBI, HDFC, Kotak, whatever. They will be required, and they will give you approval that yes, you can hedge. Why they need to give approval? Basically, because these hedgings are happening overseas, it involves FEMA, right? So foreign exchange transactions. And hence RBI has made a rule that an AD category bank will be involved, who will be looking at all your transfers related to commodity hedging. Okay, so that's why this bank's approval is required, but it's not a problem at all. Okay, not a problem at all. So you can hedge direct or indirect exposures. Okay, the permitted hedge instruments are you can do futures and forwards, and vanilla options are also possible, plain option, call option, or put option. But structures and all are allowed with restrictions. Only certain kind of companies with which are large companies can do structured products. So swaps are nothing but again futures only, basically. These are called swaps. So when you are, so you have to approach one broker or a counterparty, OTC counterparty, either a broker or a counterparty, who will give you access to LME, CME, different exchanges. And you also to catch a AD category 1 bank who will ask you for a risk management policy. You need to have a risk management policy, and who will open a commodity hedging account for you, current account for you. All your transactions will be happening through that. So before opening that account, the bank will check, okay, do you have genuine exposure of the commodity? Do you have a risk management policy? You have 2 months exposure, you are hedging 12 months. Broad check they will do, and they will give approval. They don't have to go to RBI to give approval. Earlier, the process was that they need to take approval from RBI. Now the AD category banks can approve. There's no need for RBI. Who can do structured products like range forward or collar or those kind of options? If you want to do in these exchanges, if your commodity allows, then you need to fulfill any of these 3 criteria. That is, either if you're a listed company, or you are a fully owned subsidiary of a listed company, or having a turnover of net worth of more than 200 crores. That's the thing. Okay, the bank will also take some annual certificate, statutory auditor certificate, etc. So these are the banks, some formalities they will ask for, annual certificate, etc. These are like operational, simple stuff, not complicated. So when you are hedging, you need to give margin. Like, while dealing in stocks or equities, we have to give margin to the exchanges. Similarly, all these LME, CME, they also require margin for doing deals in commodities. And uh, instead of cash margin, a part in guarantees also acceptable at times. And the margins vary between 6% to 15% of the amount which you are hedging. So that's a deterrent. Like if you want to do a hedging of 100 crores, so you have to possibly give a 7-8 crores of margin. And the advantage is OTC doesn't require the margin. OTC margin requirement may not be there, or it depends on your counterparty. If they can sanction you a limit, they can write a contract with you without any margin. And second issue with the exchange is that there is a daily mark-to-market exchange. Like if your deal is making money, they'll keep getting money, and if your deal is making loss, they'll keep asking for margins. So that is another day-to-day hassle. I mean, it doesn't matter that much. We are doing for quite a few companies. It's not like a real hassle, because if the quantity is reasonably small, then it's not a problem. But the mark-to-market issue is not there in the OTC market. OTC market, many problems are solved. The only problem is that the price becomes a tad on the higher side. I mean, it's highly doable, I would say, because if when we check prices and we ensure that the right price, then there is no problem. So OTC is also quite good.